distinguished executive dialogues. This is part of our Armenian Virtual Bridge series, the accelerator that we have established 5 months ago, and we're through it, we're training 15 companies, startups from Armenia. The Armenian Virtual Bridge is a program that is organized by HBU Silicon Valley, along with the high-tech ministry from Armenia, and in collaboration with the HBU Armenian Virtual College. Today we have a distinguished executive with us, that is Shariq Rizvi. I'd like to invite Mariam Hampartian to introduce him and to coordinate the session. Mariam?
Hello, everyone. Thank you so much for joining, and thank you so much, Shariq, for joining us. I would like to introduce Shariq Rizvi, who's the Executive Vice President of Monetization at Reddit. Shariq began his career as an engineer at Google. He's also a serial entrepreneur and has exited both of the companies that he has started, one of which was Dascient, which was acquired by Twitter. And then as Director of Engineering at Twitter, Shariq co-led the launch of Twitter's performance ads business. He built out multiple engineering teams from the ground up, and he helped steer the company through its IPO. He has incredible experience both in corporate as well as on the entrepreneurial side. So today he'll be sharing his insights with you and taking your questions. He'll cover a lot of different topics, including fundraising, product market fit, and whatever other interest our cohort participants have, as well as the audience. So Shariq will begin with a bit of a presentation, but please jump in with questions, and we will also have Q&A at the end. In order to ask a question, I ask that you please click on the bottom right reactions and click to raise your hand. At that point, our team will enable your microphone and video, and you're welcome to jump in and ask a question. An alternative way would be to post your question in the chat, and I will try to moderate and jump in and ask those as well. Thank you so much. Feel free to begin, Shariq. Thanks.
Hello. Okay, so now I've been unmuted. Hello, everyone. So good morning or good evening, based on where you are. So allow me to hit present, and it's great being here. It's always exciting to be with entrepreneurs. Entrepreneurship is the core engine of value creation and opportunity creation in the world. So when I heard that I would have the opportunity to spend time with you all, I could not so let go of this great opportunity. So Mariam was nice enough to send me a brief of all the startups, the 15 startups in the current cohort of the accelerator. And as I was reading through them and the profiles of all of you behind them, the first thing, the very, very first thing I noticed was the fact that these are people, these are entrepreneurs who have already gotten started. And I had to bring this Mark Twain quote in, which so draws out the line, the difference between people who think they will get started one day, so and those who have already gotten started. And it's always a privilege to be with people who have already started the journey, and it's great being here. When I was thinking about what topics we could talk about today, there were two that were especially given where the startups in the accelerators cohort are. So most of them are, about 1, 2, 3, or 4 years into the business building journey. There were two topics which are close to my heart, and I hope so also extremely relevant to you all. The first one is what I call the investor mindset. It is very closely related to fundraising, but it is really a decomposition of how the investor approaches participating in any opportunity. And this could be the classics VC investor. It could be an executive in a larger company who is trying to figure out what new things to invest into the next quarter, the next year, and so on. Or it could even be an employee, an early stage employee who you are trying to close during your team building, because they are also investing with their precious time. And to be honest, the most important so investor in your startup is you, because you are investing your precious time, a key part of your life in this journey. So I think so that will hopefully be some very useful discussion. We will so pause after that. I will invite the questions, comments, and thoughts. And then for the second topic, so I thought, we are early stage startups here, and you can almost never have enough of a discussion on the product market fit, uh, you know, uh, what it means, how we generally get there, what it feels like, and some so common so problems that as entrepreneurs we often encounter uh, during that journey. So those are the two topics I thought we could cover today, and so hopefully we can keep it so interactive. Please, so feel free. It'll be great to make this a lively discussion, and don't so hesitate to stop me at any point. Um, and with that, uh, if the game plan that sounds fine, so allow me to get started. The investor mindset. This is a framework that I was first introduced to by my fellow co-founder of my first startup. He had come out of the McKinsey, which was a strategy consulting background, and this was a framework they had used when so helping various business leaders so evaluate opportunities. It's a 3 points framework, and I will drill down into that, especially in the early stage startup context. We first ask that, is this worth winning? This thing that we are going after, and as we try to bring more people, early stage investors, more employees into this journey, is this worth winning? If the answer to that is yes, we ask, is this winnable? And if the answer to that also is yes, then we ask a question specific to our team, which is this winnable by this team? And so allow me to drill down into this investor mindset, one, two, three framework now. So worth winning, which is in some sense the most important piece of this framework, is around how big a business can we build, and it's tied to how big an opportunity is this. Um, all of us also have passions on the side. We have this, we have our side projects. Has some of us do stuff on the side through open source projects. Um, when we are building an early stage business, it's more than just about a side project. It has to be about winning, and hence this is the first point in the 1, 2, 3 framework. Is this worth winning in the first place for all stakeholders in this journey? If you are disrupting an established category, which is loosely spelled out as, you are going after an established spend, an established market where the budgets are relatively well known and carved out, then this translates to talking about how big is this market, how fast is it growing, and where do we all expect it to be 2 years out, 3 years out, so 5 years out, when our startup is ready for prime time. And because in this case we are talking about playing and disrupting in an established category, there's usually top down research available, e-marketers, Forrester, and so on, about how the market is moving in recent years and also going into the projected future. The a very relevant example I share here is Pinterest and Snap, which are now tapping into the digital ads market. The digital ads market has been around since 1995, so it's not a new market. But Pinterest and Snap, which have done most of their business building in the 2010s, the last decade, they said, okay, this is a huge growing category. When they started building their businesses, the global digital ads market was already about 200 billion dollars globally and growing. And then their journey was about disrupting that established market. On the other hand, some of us may be creating a new category, which is which is riding on the changing world. So we are in a changing world where the underlying forces are new and evolving. And that's when we ask, what are the trends we are riding on? And what do we need to believe as founders, early stage investors, early stage employees on where the world is going and where it will be for this to be worth winning? And when you are chasing these kinds of opportunities, you usually don't have the luxury of having clear top down market research, but that's when you do the bottom up, so sizing and trending and projections. So along with some hopefully reasonable assumptions. A great example of this, so I think would be Uber when it actually started in 2009. There was no such thing as the ride sharing market, so people when they wanted to go for local transportation, there was the public transportation. They would hail cabs, or they would drive their own vehicles. And then Uber, they rode on trends like the smartphone revolution, uh, the opening up of smartphone apps on top of the smartphones platforms, and more trends. And they have now created a whole new category called ride sharing, which globally is about to cross hundreds of $1 billion of annual spend. So those are some ways to think about and to reason about, is this worth winning? Now, if you are convinced and your stakeholders are convinced that this is worth winning, we move on to the second thing, which is this worth winning opportunity? Is it winnable? Is there a credible, believable strategy to win this opportunity? And if you are disrupting an existing market, then this boils down to understanding what is the landscape like today. What will be the drivers of differentiation? If this is an established category, then the newer or younger player has to be, say 10x better on some dimension of customer choice, some dimension that the customers cares about. And then we also need to answer the why now question, which is, why is this disruption likely possible only now? A great example here, we have to go back all the way to 1994 when Amazon started. Their e-commerce business building journey. So initially being just a bookstore. And the answer to why now was clearer because the internet had started becoming a thing. It was only now possible to buy things online. And then for the differentiation piece, so Jeff Bezos and team, they very cleverly, they went after books as the first slice to go after, because what was 10x better there was the fact that someone who wants to buy a certain book was 10x more confident that they would be able to find it and get it on the Amazon's bookstore than if they drive 15 to 20 minutes to a local bookstore. They may not find that book there. The pricing could be debatable and so on. So that whole experience, that the buyer, was now reasonably confident that I could buy the book I want from a large collection so more easily at the right price, was the dimension of 10x had differentiation. And then what rounds out the winnable piece is that once we have started winning this opportunity, what will be the path to building some defensible moats? I'll be talking about this a bit more in the next slide. Also related is when the user is consuming the value proposition that we are offering, where are we in the value chain? Do we own the whole experience, or are we just a part of the value chain? And if the answer is the latter, what does it mean for us and our winnable strategy? I think the example that comes to mind here is how Amazon over the years have built their product search. As we all know, Amazon was originally not a product search engine. They were just an e-commerce player, and most so users so relied on Google search to find what they would ultimately buy on Amazon. And Amazon was, of course, so smart enough to so realize that they would they wanted to be higher, they wanted to be more so pervasive in the value chain, and they didn't want to give so Google the opportunity to start with the product so search experience and then build an e-commerce so competitor. And then as a result of that, Amazon has now built out the product search. Starting 2019 in America, more of the products so searches now happen on Amazon than Google. In other words, when it comes to product search, so Amazon is the more popular search engine now in America than Google. And then, of course, there is, you know, as a part of this, the winnable strategy, what is the capital requirement? We have a business plan, an early business plan. Where is it directionally going? So in terms of the amount of capital required, the more capital so you need across the longer so period of time, that adds more risk and may make this opportunity less, say, winnable. So that's how the winnable aspect of the framework can be generally approached. To close out, so this piece here has some examples of what eventually turn out to be sort of defensible moats. There is often the proprietary tech. You have built something which is hard to replicate. It's not impossible to replicate, but it has given you a lead, at least a 1 year lead or a 2 year lead, that even if a larger company wants to change its directions, they will take time to catch up to that. And of course, this tech only matters if it translates to the value proposition, so in a way that it is, say, 10x better, again, on some dimension of customer choice. Then there are business models where the moat is driven by network effects, social consumer platforms like Facebook, Twitter, Reddit, and so on. These are platforms where, as more users join, the more valuable and attractive the platform becomes to more new users. And the same is true for messaging apps. Then as a business grows, say, further and further, how they have their relationships with the distribution partners, the resellers, that also creates some very defensible moats. While being first to market is not a mode by itself, you will often hear the jargon that what so really matters is first to product market fit, not first to market. But brand, in some cases, so can be a pretty defensible mode. So of course, this is more valid for late stage businesses. A great example would be Apple, which is the Apple brand has won so many hearts and minds that now, so someone who has an iPhone every 3 years or every 2 years, when it's time to change their phone, they don't wake up and say that, okay, now I'll want to buy a new smartphone. They say, now I'll want to buy a new Apple iPhone. So the brand itself has started to become a category, and that is a defensible moat. Very hard to build, but can be extremely valuable if when companies they get there. So that is the winnable piece. And the final piece in the framework is, okay, so now we believe that this is worth winning. We believe there's a winnable strategy, but is this the right team to execute on the winnable strategy? And this, the kind of questions that get raised, especially for early stage teams, is, does this team have company building experience? Is there a play around domain expertise, which so another team to do the same thing will just take a lot of time to understand the problems and the customer. Another one here, which is often very key, is this early team, that they have some history of working together? Do they complement each other, or are they just getting started, so in terms of their interpersonal relationships? And last but definitely not the least here, I would point out, is the question that, is this early startup team has self-aware? Are they aware of, given where they want to go? Where are the gaps in their team, and do they have the willingness to fix those gaps? So I think these are some crucial questions that come up in this third point, which is this opportunity and this strategy so winnable by this team? um, Something a bit so tricky happens if you have done, as entrepreneurs, you have done a great job of convincing a potential investor that this is indeed so worth winning and there is a winnable strategy. But if we cannot so convince them that it is so winnable by this team, then you could end up in a so tricky situation. I have had friends who were in this situation, and I'm not trying to paint all so VC investors with one brush at all. They are an extremely valuable part of the startup ecosystem. But if you are able to convince someone that this is so worth winning and so winnable, but not really able to convince them that this is the right team, then you have so left open the possibility that they are excited about the opportunity, the strategy, but they may want to find another team to back. Uh, Hopefully that would never happen in your case. That is so something to keep in mind of how a rational investor may think. Uh, yeah, I want to close out this part with so talking about, as so someone who has done early stage so fundraising a few times, has helped others so do it, some common so challenges that come up in this phase, on all the 3 points of the framework. For worth winning, one very common one is when you are going after an emerging market, which is not yet an established spend category, is will this market really pan out? How fast? How big? That's so very common one. My first startup, uh, so that was a key question that we all had to address. We were going after a specific aspect of web security, and it was an emerging market. When it comes to winnable, this is often so becomes a key so bottleneck question when you are going after an established category, which is there a path to a strong enough differentiation, and can we get there so faster and with enough defensibility that we believe that a larger company cannot build this in a reasonable amount of time if they want to. And then on the team side, often things that come up are around, you know so first time entrepreneurs, so first time that a group of people are working together, and so expertise that the team may not have today, but they need to get to the next level. So these are some common issues. We all have dealt with them. Very so valid questions. Before I talk about what are some common ways to approach addressing these challenges, and of course, there's no one size so fits all so solution. But before we so go there, I want to point out that this whole so process of trying to bring on more stakeholders in your journey, be it early investors, be it early stage employees, and facing all these kinds of questions, that itself is a very valuable exercise. And again, this goes back to my point of that you are the biggest investor in this journey. And so each time you get these questions, it should be an opportunity for reflection and making your story even stronger. Here are some common ways so in which people usually deal with these kinds of challenges. Angel investors, they are a great source of early stage funding. I'm sure you all are aware of that. Some of you are actually, you I'm assuming are beyond the first round of funding. Um, and they are very useful for early stage so startups because they often invest based on their personal so passion for so helping people in specific areas. In my first startup, which was a security company, we were able to raise some good angel funding from previously so successful security entrepreneurs, and they were extremely passionate about the security space, about so helping build more businesses in the security space because they understood that space so really well. They were also, these are often people who are very passionate about what's called paying it so forward, which is they have been helped in their journey by someone else, and they want to keep that value chain going, and they want to pay it forward. Another thing to so keep in mind as you address these early stage challenges on the fundraising side is to stay lean before you hit a product market fit. We'll be talking a bit more about that in part two. And of course, there's no substitute to being self-aware about where is our team today, uh, what are some gaps we know we need to fix in the team to get to the next level. And as a way of so proving out the self-awareness to actually make the team building plan a part of the operating plan that you show to early stage investors. So I think that's also an exercise which goes a long way in showing that the team is very so self-aware and so eager to evolve the team to go win this opportunity. So let me pause here. Uh, Hopefully, this was a useful so framework to approach how the investor is thinking about investing in an opportunity. And let me invite questions, comments, thoughts, even any criticism is more than welcome.
Thank you, Shariq. This was an insightful overview. So I want to encourage the folks in the audience and our teams to please jump in with a question. Just click on the reactions to raise your hand and I'll unmute you. Sad case. Go ahead.
Hello, everybody. Thanks, Shariq, for sharing your thoughts and your experience. That's extremely valuable. Can't agree more. My question is regarding the examples. It's always easy to analyze in a retrospect and say, let's say, Amazon did this right thing, focusing on books and so on and so forth. But how Amazon did landed on that decision, I think, is important. So because on the early stages, directions are allowed, and you are not skilled enough or you don't have enough data to focus on one thing, sometimes you end up diluting your focus. So, what are your thoughts on that? How to keep the focus and how to decide on what to focus? Thanks.
Yeah, that's a great question. I completely agree that in retrospect, so we always say that hindsight is 2020. So in retrospect, um, when we analyze the success cases, it is always easy to lay it out as a no-brainers for success, but that's almost so never how it plays out. Um, One comment I will make here is that I think it is true when, if you read the biographies of people like so Bill Gates, the late so Paul Allen, stories around Jeff Bezos, like these are some of the largest so successes that have come out from the tech industry. So I think it's fair to say that while they saw the possibilities, the worth winning opportunities, and they had what so turned out to be the successful hypothesis for both the worth winning part and how to win part, the winnable part. So I think it's fair to say that uh, I don't think even these extremely successful entrepreneurs they had imagined how big the success can be. when Jeff Bezos so started so thinking about and saying that, oh, today it could be a 1.6 trillion dollar company over time. So that I completely so agree that the size and the sustainability of the success was not something that people see early on. But I do believe that early stage entrepreneurs, they have a strong hypothesis and evolving hypothesis on why is this so worth winning and what is the winnable strategy. One quote I hear so a lot from some of the early stage entrepreneurs who have done well is having strong opinions loosely held. So an early stage entrepreneur needs to have strong opinions. That's what so gives you the grit. That's what so gives you the confidence to keep marching and keep your so team marching. But at the same time, those opinions have to be loosely held and open to change when you run into new information, new opinions. Um, so that is one comment. So regarding your very specific point about uh, how to decide what to say yes to and what to say no to, I will touch a bit about that in my part two, which is in when we so talk about how we get to a product market fit. So there'll be some discussions so there about if you're not yet sticking with a so larger market, you can narrow it down. So as long as you still believe the opportunity is large enough, and you believe that you have a stronger chance of so winning in this so narrowed down market. So there'll be some discussions on that. Uh, Another comment is that there has to be the spirit of ruthless prioritization, which uh, is and this is not just true for early stage startups, but also when you go into later stages, you will always have more things you can go after than the resources so you have. So that's that spirit of ruthless the prioritization has to be an everyday part of our playbooks. So those are some thoughts that come to my mind. I don't think it's the silver bullet answer that you know uh, that I can give or anyone can give, but hopefully that's some good food for thought.
Thank
Awesome.
you.
Thank you. So let's go ahead with our next question from Mikhail Avakian.
Hello, I'm Rosa at the place of Mikhail. Um, thank you very much for the great presentation. It was very interesting. And let me ask you about the slide that was before this last. It was about pre-PMF. Can I see that slide? Here is it. Yes, stay very lean pre-PMF. We are working on the startup, B2B startup inventory and wholesale management system. And we already have several sales in local and international in US market. How can we measure where we are now in PMF, pre-PMF, or maybe we are already on post-PMF? Because as far as we are reading books, there is very, very hard to find out where we now stand.
Yeah.
And how to go on.
So great question, and a very core question, which is at the heart of this early stage startup journey. And I'm glad, Rosa, you asked this because you are essentially making for the case for my part two. So if I could just request you to wait for a few more minutes, we would get into exactly that kind of a conversation, which is let's try to define, let's try to agree on what a product market fit is. Then we will talk about how companies get there, um, the common ways, the common activities that lead to that, and then about what it feels like. What are the signals that you have hit a product market fit? So if you can just hold on for a few minutes, that is exactly our part two.
Sounds
Thank you
good.
very much. It's very interesting.
Thanks, Rosa. I'll go ahead and ask Digan to ask his question, and then I guess maybe it's a good segue into your next part, Shariq.
Yeah.
Hello. I have some advanced question, not only regarding this discussion. Are you believe the next Silicon Valley will be in Armenia? Can
Yeah,
you
it's a great question.
okay? So please don't interrupt. Can you do some guarantees to believe developers and entrepreneurs will starting some homemade projects to stay in Armenia and not leave the country?
Yeah. So I think the first thing I can say is a trend that was already going on in the global tech industry and which clearly got accelerated is how companies are basically everywhere, which is a company when now leaders in the tech industry, and this is also applies to how I approach my own team building every day at work. There is now this new approach that we have to build a company where we go where the talent is. The companies have to be remote first, which means that uh, there's no desire now for a big part to hire people and then move them to where the offices are. So that is a trend which has clearly accelerated in the whole tech industry, and I see it every day in my work in recruiting. Now, so I think one of the side effects of that trend is you see various signs of this even within the US. The kind of stronghold held by the Bay Area in California is very quickly loosening up, and new hubs like Austin, Miami are so emerging for people to build early stage companies and scale those companies. So even to scale those companies, you don't have to come to the Bay Area, which was was so kind of the common playbook until say 5 years ago, or definitely 10 years ago. So I think that trend is
1 minute. Okay.
Yeah, go on, please. Yeah.
I'm doing now with the team refresh.am project.
Yeah.
It's a homemade project started from May 2020, and simply we are trying to get investment, and we are trying to get investment at first from Armenia, not only from Armenia, from other parts of world, but we are thinking about some questions about intellectual property, data store or laws in Armenia, and other things. For example, one question: keep dedicated servers in Armenia or keep cloud servers in United States, or some similar questions.
Yeah. My quick answer to that is the trend that I spoke about will open up more opportunities than ever before. But when it comes to some of the regulatory stuff that I think you are alluding to around data regulation, so privacy regulations, I would rather not go too much in there, because that's very specific to verticals, to the kind of business you are trying to build, and the kind of customers you are going after. Yeah.
Awesome. Let's go ahead and continue. We'd love to see the product market fit section and dive into some of the other questions.
Thank you very much, Mariam. So my part two is around this concept of the product market fit. So most of you have spent time accessing this common wisdom that exists in the startup land, and it is often split into two parts, which is how life looks for entrepreneurs, for early stage startups pre-product market fit, And that's where you hear keywords like hypothesis testing, staying lean, not so over hiring, and how life looks like after product market fit, which is where it's a lot about building a scalable, repeatable go-to-market playbook, the unit economics. Because we are early stage startups here, so I thought we would focus on the product market fit part. And so some topics like what do we really mean by product market fit? There are like so, so several definitions. I'll share with you my favorite one. What are the common ways to get to it? So how do we know we are there? And some common problems. I go with the Mark and recent definition, where he says that the product market fit means being in a good market with a product that can satisfy that market. And this has two parts to it, if I'm allowed to decompose it. So one is being in a good market, and that's what I would tie to the within the investors mindset, which is what are your hypotheses around the worth winning and the winnable piece, and that goes into the market being a good market for you. And now, because the very next thing we are going to do is to align a product to this market, you have to start talking about the targets, so personas, which is who is actually the user of this product and what are the use cases or pain points they use it for. And for B2C products, we had talked about the user being the buyer, but for this can go all the way. For if it's a more complicated B2B sale, then the user, the decider, and the budget holders can be different persona. So all these things, they go together in establishing what the good market is. And then, of course, the second part is the product. So you are talking about building something that satisfies this good market. And that's when we talk about, have we reached a point where the products or features are so, satisfying the persona and the use cases we just discussed. The delivery model. So, the same core, say, features, they need to be delivered so in a way that the market, the target, so personas wants to consume them. A great example of this is if Amazon today was not available on a mobile app, I would probably want to find another e-commerce platform which I can access through my iPhone. And so the delivery, and that also speaks to how you can lose a product market fit. So we had hit a product market fit, and then because of trends that move the ground so under us, we can lose a product market fit when the use cases and the pain points of the target's persona uh, uh, they changed because of the ground under us actually is shifting. And then another core piece is the pricing part, which is if you think about social consumer platforms like Twitter, so Facebook, and so on, and the kind of product market fit they have hit on the consumer side. A key part of that is having no barriers, having no pricing barriers um, for growing the consumer platform. You know, that's just one example, and then there are, of course, other pricing models that align with how the target persona wants to consume the value proposition that goes into the product market fit. So that's that's loosely how I think about what a product market fit is. As always, much easier said than done, right? Uh, so getting to it. So again, no silver bullet, but uh, so we have built products. We test them with customers, and there is the iteration. What people don't often talk about much in the early stage startups world is, as we are iterating the product, we are also iterating or evolving the targets, so persona, so use cases, and the values, so hypothesis, um, which is we need to make our targets, so persona, so sharper and so sharper. There was a question so previously that I postponed to this part two, which was, um, if like, so how do we know we are getting to product market fit? If we know that what we are trying to push into the market is not sticking, then so one way is, uh, you know, then one lever is to, of course, iterate on the product, but another key lever is to be very open to iterating on the targets, so persona, and the use cases and the value hypothesis of what our product, uh, who it, who it is for, which use cases, and how it will create value for them. Um, most people who advise early stage startups will also tell you that the choice of so market, which is, which so includes the targets, the persona, and the use cases, is a very critical component of getting to the product market fit. You want to find market, and if not, then a slice of that market, a sub market, where the customers are in enough, say, pain, in a good way, where the pain points are so real, so immediate, that the market also is pulling for a product so like yours, and you are not just, say, pushing that product into the market. I have to admit that this is never a super structured, well-defined exercise. This is often a very laborious, painful part of early stage startup building. I've been through it a few times. Uh, the magic, when it happens, it happens somewhere between the customer and the early stage startup. There's this famous quote from Henry Ford that kind of makes the point that that the customer, at the end of the day, it may, the customer may not know exactly what they want. They may know their pain points. In some cases, the pain points themselves have to be teased out through user research, but they definitely don't know in most cases what the right product, the right way to satisfy the market will look like. And so that's why this exercise, always so hard to do, always much easier said than done, but is at the core of early stage startups. This ties in with a question that had come up earlier, which is, how do we know we have gotten there? Here are some signs that I've seen in the past. I've, some of the advisors I have worked with, uh, you know they believe these are the signs that, that tell you that you are getting there. It's not a 1-0 point. It's not just a single point in time. There is some such thing as an early product market fit, and then a deeper fit. But these are some ways in which you sense it, which is you are becoming a daily habit of people who are working with you as design partners. If it's a B2B idea, if it's a B2B startup you are working on, then you hit a stage where your internal champion in those companies, they want to get serious now. They want to talk about commercial terms, because they are investing their time. They want to formalize the relationship. They start asking you questions about how robust is your company, who is backing it. So those are some signs that you are getting there. And so, of course, another great one is your customers. You have started developing champions. People are starting to do the selling for you. Okay. Uh, some common problems, but also extremely hard problems, is you are trying to build a product that eventually needs to converge. You have to sell the same product, ultimately sell the same thing over and over again, uh, to multiple instances of that persona for that use case. And so your product has to converge. And in some cases, the reason it does not converge is early stage entrepreneurs, they refuse to in parallel iterate on the personas and their use cases, and that's why they end up going after a diverse set of personas and use cases, and the product then starts to diverge, not converge. So again, easier said than so really done, but so something that we all have to keep an eye on. So another one is, if you're not already there, then we should be moving fast. That is not iterating so fast enough. So another one is often, I was guilty of this as an early stage entrepreneur who was a former engineer, which is we love what we have built. On the other side, we often have other engineers or so other so tech savvy people who are interested in what we have, who are interested in seeing it be successful, but just interest is not a product market fit. Uh, and then, another so common one, and which can be a success or problem if you are too good at, say, fundraising, you can raise, uh, you know, uh, you can raise some good capital, and then that could put the pressure on you to do, uh, to scale too fast. Every now and then you hear so examples of premature scaling. The most so recent one that comes to my mind is QB, which was a startup that really started. It was a company that really started about 1 to 2 years ago, I think, and they went after a new class of videos of consumer video consumption. Was started by some of the giants of media and the tech industry. They effectively raised a seed round of $2 billion or so. So this was, I call it a seed round because they were pre-product market fit. Scaled up the company to 250 plus people, but then recently so shut down, was not successful. And I think one of the key lessons so there is we cannot brute force our way to product market fit. We have to do the work to hit a product market fit. Um, and sometimes raising too much so capital early can put you in a difficult position. So something to also be aware of. Okay, so I know we are approaching the hour, but that's the part two I had for you. Mariam, do we have time for a couple of questions?
Yes, let's have Sakesh jump in with a question.
Okay, I'll be quick. Could you please speak a little bit of numbers? What product market fit, like signals for product market fit? You mentioned NPS score. So what should be that number look like that signals us so we are close to product market fit? Or other numbers, we can quantify. Thank you.
Yeah, I think that's a great question. I'll also share with you one number that I worked with in the past, or I negotiated with our stakeholders, which was in the journey of building um, building uh, a B2B enterprise oriented startup. We held a belief that if we could get to 5 enterprise, say, customers, so 5 was, I think it was an arbitrary number, but a directionally consistent number, 5 enterprise customers where the same kind of the user persona was championing our product, and for the same kind of use cases. So that was like having narrowed down on the persona and the use cases was a key part of it. So 5 or so enterprise customers using our product in production, which is not just in testing, but as a part of their, in this case we were dealing with a startup that was building a cloud application monitoring software. So the target persona was born in the cloud native companies. We had narrowed down the persona to only AWS hosted customers to make it easier for us to build for them, and still a large enough market. So that's how we had defined it, uh, which was in about 5 or so enterprise customers with those constraints. And in terms of early revenue traction, we had said $500,000. So across those
I think we may have lost Shariq due to some technical difficulties. I guess since we've already approached the hour, we'll wrap up. I want to. Oh, there you are. You're back.
I'm back. I'm not sure if the problem was on my side. It looks like that. Yeah.
Sorry, go ahead and wrap up. Thank you so much.
I mean, I was just answering the question that came up, which was around a quantitative example of how we can define a broad market fit. So for us, when we were building a B2B enterprise-oriented startup, we had internally agreed that we want to get to 5 enterprise customers, having narrowed down on the same or very similar persona, same or very similar use cases, and have them be using it in production. So that's one example. So again, it's not a one size fits all approach, but hopefully that's that's a specific quantitative example.
Thank you.
Wonderful. Thank you so much again for your time, everyone. I'll pass to Yaman for some closing remarks. Shariq, it was a pleasure to host you. Very insightful thoughts.
Thanks for having me here.
It was really very exciting, very insightful, Shariq. Thanks a lot for your contribution. Thank you all for making this interactive. And Mariam, thank you for coordinating it so nicely. So this series, which means the Distinguished Executive Dialogues, we'll be continuing them on a weekly basis with you. So the next one will be the Chief Technologist of Mubadala. Mubadala is this investment firm in Abu Dhabi. You may know it. So he will be coming here and sharing with us investment and technology overlap component. That will be next week. We'll send the invite to all of you to follow. Again, thanks a lot for joining this 4th episode. And thank you so much, Shariq, for all the knowledge you shared with us.
Thank you. Bye.
Bye-bye. Have a good day. Good evening.